How's it going, everybody? This is Ed Ponsi, your FX educator here on behalf of FX Street once again. Welcome back. I hope you enjoyed the first segment. If you missed it, this is our second segment here on FX Street. We frequently do 2 segments a day around this time of day, 2 half-hour segments. We answer your questions, and we do the charts, we do the technical, the fundamental, the risk management, whatever is on your mind is something that we will be discussing. Last night I was on CNBC. If you missed it, please take a look. Enjoy this CNBC clip. It's been referred to as merciless by some of my associates, where I really called out the European finance ministers and folks of that nature. So I hope you enjoy that. Now, get your questions in. If you have a particular currency pair that you'd like me to chart for you, let me know. If you have a particular question about fundamentals that you'd like me to answer, now's a good time to enter that. If you have a question about risk management, now's the time to enter that. We have a half hour, and this is your show, so let's get on with the show, as they say. First of all, I wanted to point out that that transportation orders were in fact very, very good. Or were they? You tell me. What do you think of this? We'll go to the FX Street Economic Calendar. 5.7%, like looking for 3.8. Right? Is that so? Your expectation is 3.8. You come out with 5.7. That's way better than expectations, right? Or is it? Right? Because if you look at it ex transportation, the number is really not very good at all. It's down 0.5%. Now, how does that happen? Well, it's simple. Transportation goods are what we call lumpy, right? You get a big lump of orders in one month, and then the next month you get nothing. Here's how it works. You get something like Boeing, right, or Airbus. But Airbus, of course, is the European equivalent. This is a U.S. number. But you get something like Boeing might get a large order for, say, 30 airplanes, from an airline. And that might happen in one month, and then the rest of the year that airline does not order any airplanes at all. So you get orders come in one big lump like that, and then it's over. So the airplane orders tend to skew the number. That's why we take them out. That's why this is X transportation. We also take out automobiles because automobiles skew the numbers. Automobiles skew the numbers. Why? Because, let's say in September they introduce new models and there's a big sale. So there's a whole lot of sales that happen in September. Then in October the sales are over and everyone who was looking to buy a car already bought a car in September. So by October, November, the sales dry up, right? And so on and so forth. They'll have big sales events around certain holidays in that month, like the 4th of July here in the U.S., right? And you'll have big sales around that time, and then it gets really quiet. So you get what we call big lumps in the order, big chunks of orders. So really, the durable goods looks great, but if you take out the airplanes and the autos, it's not good at all. And I'll take you one step further. If you take out defense spending, it was down 2.7%. So that's really bad, right? You take out defense spending. Why? Because if you take out defense spending, you're left with something that we call core capital goods. And what it means is if you take out defense, then what you're left with is business spending. If you take out defense, we were down 2.7%. That means businesses are not confident. They're not spending money on durable goods. durable goods, that's something that's heavy and it is built to last, right? So your washing machine is a durable good, but the clothes that you put into it are not. Does that make sense? All right, so anyway, within this number is actually really bad economic news. Core capital spending is at its worst point since July of last year, and that is a negative, and that's my takeaway from this. So it looks great on the surface. Under the surface, it's not good at all. Okay, and so if we take a look at the 5-minute on the S&P, does the 5-minute S&P really care? Not really. We had a little dip at the time of the durable goods, and then we're back up. But really, it's kind of quiet out there right now, and I think the stock market here in the U.S. is probably more concerned with Europe than it is about durable goods right now in the U.S. Okay? All right. Let's continue. Let's get to some questions here. Views on Canadian dollar, please, and dollar Canada chart. This is a fascinating chart for me. First of all, remember, I'm going to take you back to this point. Remember we said the dollar looks strong, but the dollar index is mostly euro. So yeah, it's had a great run since the beginning of February, but look at it individually against certain currencies. We looked at the pound against the dollar, and the pound looks like it's getting ready to rally. The pound's not a particularly strong currency either. You look at dollar yen, and dollar yen looks like it might be forming a little double top and breaking down. In other words, the dollar is not strong against the yen, but this looks like, what are we seeing here? It looks like a possible reversal for the yen, a possible reversal for the pound, which I already showed you, and let's take it one more. What is this? It looks like it could be a double top on dollar Canada. So everything, not everything, but certainly a handful of currencies look like they're setting up to reverse against the dollar. Just like we took out transportation, we took out airplanes and autos out of the durable goods, I wonder what the dollar index chart would look like if you took out the euro. Probably not very good at all. Probably not very impressive at all. So that's a concern. But this looks to me to be a double top. Here we can take these guys out, 50 and the 200, and just look at it very plainly. Very plainly here. You have a double top that is, conservatively, I think you could say it's about 125 pips from top to bottom. A little more than that, maybe about 140 pips from top to bottom. And usually that means, if you use a simple measuring technique, that would give you a target of right around this area here, just trying to be symmetrical. Now, of course, you might want to push that up a little bit, especially considering that there's a little bit of resistance up here. That would probably be my target area. There's really nothing to stop dollar Canada from falling in here. What really happened is, the greenback has been very strong lately, but it looks like reversals are setting up all over the place. And remember, except on Aussie, which is already kicking the dollar's butt. Aussie dollar is already doing a number on the U.S. dollar, and now it looks like these other guys are getting ready to reverse against the dollar. Everything except the euro, which is really getting pummeled, and the Swiss franc is not really setting up as a reversal either. The Swiss franc really looking very similar to the dollar index, which means that, to me, that the Swiss franc is really just doing the exact opposite of what the euro is doing. And, this is the one that's pushing the dollar index up. If you took this out, the dollar is not looking very good against a series of currencies, including Canadian dollar. And, listen, Gold has not done well recently, and that's hurt Canadian dollar. Oil is starting to pick it up again. All right, there's yesterday. That's a very strange looking chart. We were in a sharp downward channel. We went sideways, but usually when we go sideways, it's not this volatile. So it's a volatile sideways market for oil. And oil and dollar Canada are not very correlated these days. I would agree with that statement, absolutely, Forex Gal. What I'm saying is that they're potential influences. If gold were to pick up, if oil were to pick up, those would be potentially positive. And then maybe oil is going to pick up. I don't know, but this is a weird chart. You know, sometimes charts give you very clear, very concise patterns that you can trade and play around with. And sometimes they're just a mess. And you know, this is the latter case. This is just a mess to me. I don't see anything tradable on this oil. I'm glad I don't trade this right now. I'm not trading oil because, man, it's ugly. It's just not a good chart at all. What's the trend? What's the directions? It's kind of hard to say. But no, they're not that correlated. And I just want to clear something up too, because this came up in an earlier class, not today, but earlier this week. We don't want to ever make statements or make assumptions that because gold or oil is moving in a particular direction, that a particular currency has to do X, right? If gold is going up, the dollar does not have to go down. They can both go up, and I do believe somebody asked about that. And a lot of times they do go up together. A lot of times they do go down together. Some of these correlations don't mean the same things that they used to mean because the markets are, let's just say they're somewhat distorted by quantitative easing and things of that nature. Maybe you're not seeing the market express itself freely. Would that be a fair way to put it? The market is not really allowed to express itself freely because central banks feel the need to get in there and try to stimulate. And because of this, sometimes I think you're looking at it distorted. You're looking at through a funhouse mirror at the markets. You know, and it's not necessarily, you're not necessarily seeing, you know, free markets, you know, charts mean more when the underlying is expressing itself freely. And when you start interfering with that, then I think the chart becomes a little less important. Still important because it reveals emotions, but maybe not as important as it should be. OPEC thinks $100 is a fair price to achieve. Yeah, I've heard that before, and we hear some targets that it's going to 100 soon. And gosh, that's not far away. So, you know, we can live with $100 oil. I don't see a problem. I don't see that creating a problem. Pan says confusing to me. Let me know if there's something in particular that I can address there. Like, I don't know if everything is confusing to you or something particular that I said. Like gold and the dollar index both down. Yeah, I mean, right. So it's a little bit of a funhouse mirror, you know. I talked earlier about, and this had a lot to do with what I was talking about earlier. When we say gold, why isn't gold rallying if the Fed is pumping, you know, what is it, $85 billion per month into the market? How does gold not rally? It's because there's no growth. I mean, you know, the economic growth is pathetic. So the Fed spreads gasoline all over the floor, but nobody has a match. And that's why gold. If somebody lit a match, in other words, if you saw real economic growth, not these pathetic excuses for economic growth that we see right now, but if you saw real growth, you'd see some inflation. And, you know, there has been some inflation, you know, but it hasn't been the type of blatant type of, you know, frightening stuff that people are concerned about. You see in the supermarket, packages get smaller. You know, 64-ounce orange juice is now 59. Who the hell thought up? that? What sort of a measurement is 59 ounces anyway? But it's enough that it's a little bit smaller, but you might not notice. Things like that. There's a lot of tricky inflation. There's a lot of hidden inflation. There's a lot of little fees and things that are added on to stuff. It's kind of hidden. Even the Fed does this. The Fed likes to look at measurements that hide inflation. PCE, right, is a measurement that is basically, it's an inflation measurement that is designed to hide inflation. That's why they like it. So that way they can say there's no inflation, and really there's not a lot of inflation, but there's always a chance that you could see some. You could see it get worse. Some think Euro Swiss will reach 130 or 132 within a few years. I'm position trader. That's my time frame. Do you agree with that consensus? I think it could. Let's put it this way. There's a lot more potential upside than downside, I think, for Euro Swiss. But what if the Eurozone falls apart? I mean, what if Cyprus leaves? What if Greece leaves? It could go to 130 or it could go back to 120. But I think you'd have to say there's a lot more upside than downside. So in that sense, I would agree with you. This is a very, very hard pair to trade. We were all over this back in 2012, made good money on this in 2012, and then, frankly, missed the boat in 2013. Very hurtful for me personally, in the sense that I should have made, you try not to think about it that way, but you can't help but look at it. Even, someone like me who's manages money professionally, and I've been trading since 1994, I look at this chart and I say, God darn it, I should have made a lot more money here than I did. And it's funny how certain things you just cannot seem to get away from. And this is one where I haven't really been fooling around with it lately. We were all over this one last year, though, making good money. Gold and dollar U.S. Correlation. Carl, one of the ways I like to look at correlations, and this is I love TradeStation, and this is gold. Gold is in blue, and this is the dollar. There's gold and the dollar right there. Now, they have been moving in opposite directions at times. Yeah. And this is the inverse correlation that everybody's always talking about. But, there's a lot of times when it's not an inverse correlation, too. I mean, you went through a stretch here where clearly there's an inverse correlation. And then you went through a stretch here where they were moving together, and that went on for 3 months, 4 months, late last year, where they're both moving down. So actually longer than that. So you can't really say, I mean, it's very clear at times. It's very clear at times, but man, if you're betting on this thing all the time, you're going to go through long stretches where that inverse correlation is just not there. And I think, correlations come and go. They get stronger and they get weaker. Remember, risk on, risk off. 2012 will always be the year that I think of risk on, risk off. People get excited about risk on. That means stocks are going up, bonds are going down, the euro's going up, the dollar's going down. That's so last year. This year, stuff just goes everywhere, which is really the way it should be. You don't want the whole world to turn into one big trade. That's no fun. 2013, we got the yen's going this way, and the euro's going that way. Stock market is completely ignoring the euro. I love it. It's more fun this way. I don't want everything moving in sync. Yes, it's too hard to trade. When it all becomes one big trade, then you're either doing great or you're getting creamed, So I prefer this. This is better. And like last year, don't get me wrong, Barchetta made money last year for our clients, but by no means did we knock it out of the park. And listen, I know that you're going to be exposed to a lot of people who are going to tell you how wonderful they are. But, listen, if you've been in this business long enough, you got to understand the people who are running around telling you how wonderful they are, they're anything but wonderful. They're the ones that are going to be up 25% one year and down 100% the next year. And you only got to be down 100% once, and that is the end. And that's the thing, right? So usually the higher your returns are, the more risk you're taking, and the greater chance that you're eventually going to end up, at zero. And that's the one thing we want to avoid more than anything else. So risk management is a big part of what we do, maybe bigger than anything else. Jose, it's good to see you, Jose. With the Cyprus crisis, why wasn't the yen considered a safe haven like it was earlier? And the yen it's funny, the Cyprus crisis maybe begins around here, just a few weeks. We knew about it before then, but we always knew Cyprus was going to be a problem eventually. But it really only came up a few weeks ago, and since then the dollar yen has really stopped going up. So in a way, you could say that it is acting as a safe haven a little bit. But of course, the main factor is that everyone knows what's happening in Japan. I believe everybody knows that we have a new prime minister, Shinzo Abe, and he is flat out determined that he is going to push dollar yen much higher, I think. Now, he did never put a target on dollar yen, but he did put a target on the Japanese stock market, which just keeps going higher. Now, why is the Japanese stock market going higher? Right? Why? Because the yen's getting weaker, right? The weaker the yen gets, the more money, the more profit Toyota makes when they sell a car, or Honda, and the more money Sony makes when it sells a PlayStation, or Canon brings in when it sells a copier. All that, the weaker yen does that. So, you can't say that it's unrelated that the Japanese stock market, the higher the Japanese stock market goes, the lower the yen has a tendency to go. So when you say that you want the Japanese stock market to go higher and you put a price on it, you're sort of saying that you want the Japanese yen to go lower. You're not saying it outright. You're not saying it explicitly, but you are implying it. You're saying it implicitly that you want the yen to go lower. And, this is a type of statement that the Japanese have really backed off of these type of statements recently, and that's another reason why I think the dollar-yen trade has lost its momentum. And if you look at the yen, some of the yen pairs look very interesting. We've talked about dollar-yen here, right, which, again, could be a little double top, and it's kind of into its trend line. It's not necessarily bearish yet, but if that trend line breaks down, it could get very bearish. But look at this one, pound yen. What do you think of that? Does that look familiar? Looks like it could be a head and shoulders in the process of happening on pound yen, right? And euro yen, double top. All right, so like I said earlier, in the earlier session, it could just be that folks have already priced in all the stimulus into Japan. Did you know that Japan has done no stimulus yet? The new regime in Japan has done nothing, and they're not scheduled. They actually did create a plan, but the plan doesn't kick in until 2014. Last I looked, we're in the first quarter of 2013 still. Right? That's a long way. That's 9 months away. So you're not really going to see the yen begin to fall again unless and until they decide to move that forward. All right, it's kind of crazy to create those plans and then say, well, yeah, we got this awesome plan. It's going to make our economy great, and we're going to do it maybe next year. That doesn't make sense to me. So I think they will move it up. I don't know when, but at some point they will push that forward, and when they do, that's when dollar yen will start to move again, and that's when the yen will start falling again against other currencies. Until that happens, it looks like, at least for the short term, it looks like we're in for some reversals if the charts are to be believed. Okay. All right, great question from Jose, someone who we've seen in the room quite a bit. And I know a lot of you folks, we've been in there, have been in this room quite a bit on and off. I've been doing this room for a long time. I really enjoy, getting in here and having these discussions and answering questions. A lot of fun. So I hope you'll come and join us here in the premium room on a regular basis. Now, missed a few questions, so I just want to jump up. Not all patterns come to fruition. Well, yeah, obviously, and this, for example, this looks like a double top, but it's not really a double top until it breaks under that line and closes under that line and even trades under that line for a while. So, just because a certain shape appears, like I said, it has to get under that line to mean anything. British pound has to get above GBP. British pound has to get above this line, or else I'm not interested and I'm unimpressed. Right? Pound yen has to get under this line. So obviously not all patterns come to fruition, and what we don't want to do is anticipate, right? I've always said don't predict, react. I have no idea if this is going to break down. I have no idea if this is going to break down. Neither does anybody else. The difference is I know that I don't know, right? This goes back, remember Lao Tse, right? To know what you know and to know what you don't know is the mark of one who knows. I know that I don't know if euro yen is going to break down here. So I don't try to guess. I don't worry about it. I let the chart figure it out. Right? If the chart breaks down, then I say, okay, we have a breakdown. Let's get involved. I'm not going to place a trade here and guess that whether or not it's going to break down. That's a game for amateurs, and so I'm definitely not going to play that game. He feels that the cable, upside in cable, is completely against fundamentals are against an upside in cable. I don't disagree with that at all. But I'll tell you what happened here, right? We went from 163 to below 150, right? And at that point, you have to say, okay, the fundamentals are terrible in Great Britain, probably worse than any of the majors. You're looking at triple dip recessions here. So, so how could it possibly go up? Because, maybe to some point, the bad news is factored in. I mean, that's a lot of bad news being factored in on this chart. Right? That's about 1,400, 1,500 pips of bad news being factored in. So at some point you have to say, well, we all know, what the story is in the UK. We know the economy's terrible, but maybe it's already fallen enough. Maybe that's that. But again, I'm not even impressed with this unless you can get above this line, 152.80, because that is such a huge level of former support, should act as resistance. So technically speaking, we need to see this thing do more than it's already done. All right, folks, I'm sorry I could not get to all of your questions and comments, but I just want to say how much I really enjoy being in the room with you here today. My name is Ed Ponsi, your FX educator. I'm a regular here in the premium room for FX Street. Let's come on back and do it again sometime very, very soon. Everybody have a great day. Thank you so much for listening. Take care.